Welcome back. Welcome new people that are coming on for the very first time. Appreciate it. This is the quarterly meeting for Exit Planning Institute. For those of you that are viewing this for the first time, I'll give you a little background on Exit Planning Institute. So there was a study done years ago that said that in the next 10 to 20 years, there's going to be 2 million business owners that are going to be exiting their business. And so Exit Planning Institute understood that. And about 12 years ago, they created Exit Planning Institute to help the practitioners help the business owners get ready for an exit. And so what we've tried to do in this local chapter on a local basis is to create a community to try to educate ourselves on how to help the business owners and also to be able to meet professionals like yourself to help collaborate and help the business owners. So one thing I'll mention is that if you're looking to find in any area as it pertains to exit planning, you're in a great place because we got great people that are here and they can help you there. My name is Mark Kravitz. I'm the president of the Greater New York chapter. I started this chapter 7 years ago with the thought of bringing together like-minded professionals like yourself to help business owners get the best results that they can get. And I'm really proud of what we've accomplished so far and what we've created. So first, I want to thank the board members. We have a couple of board members that started right from the beginning. That's and still on the board. That's Scott Yoder and David Broderick. You've been around since the beginning. Thank you, appreciate that. And Chris Chang also started not at the very beginning, but has started really soon after that. Some of the other board members are Steve Dow, Gabe Lengua. Also, late last year, Muriel Chang had joined the board. And then we have our newest board member, old friend, but newest board member, Larry Bogar, who also is the leader in the Business Owner Forum. So Larry, we thank you for your help there. And speaking of the Business Owner Forum, we had not gotten together since the last Business Owner Forum. I want to thank the committee, which is made up of Larry, myself, Corey Masala, Gary Kane, and Joe Shiabika. So I want to thank you for that. And it was a very successful Business Owner Forum, even though it was done remotely. It was the first time that we did it remotely. We had 70, 80 people on that, and we usually do it live where we have 100 people, and we hope to do it live this year. So pencil in the third week of October. Vaccines, hopefully it'll get out there and we'll be able to all meet there. We always have great content, great people. So if you know of any people who would like to be participant in the Business Owner Forum, some great speakers that you know of, that you heard of, please contact Larry, contact Joe, contact myself, contact someone, Corey from the that's on the committee. Let us know, and we'll take a look at that for the forum. Also, future meetings, if you want to write it down, our next quarterly meeting is going to be April 20th. We are going to be doing it remotely. And then the one after that, the third quarter meeting, is going to be July 20th. Most probably will be remotely. I would think it's going to be remotely. But again, the third week of October, that's going to be a Business Owner Forum. Hopefully we can all get together there. In addition, if Biden is correct and he's going to get 100 million vaccines out in the first 100 days, and hopefully we'll be able to get that, we're considering doing a social gathering in September, perhaps bringing other groups on, the Alliance for Mergers and Acquisitions, maybe even ACG, having one big group together in Manhattan. Hopefully we can do that in September. So that's all vaccine pending. We're going to have our featured featured speaker, Alicia Levine, who's amazing. You'll love her. So when I was talking to Alicia, I asked her if she wanted to just do a presentation or would she rather me ask questions. So she preferred to have me ask questions. So I'm going to be asking Alicia questions. So first I want to read her bio, which is very, very impressive. Alicia Levine is the Chief Strategist and Managing Director at BNY Mellon Investment Management. She is one of the firm's most authoritative voices for market analysis and compelling investment outlook. Alicia provides frequent, insightful, and timely market commentaries along with original content to help translate complex economic concepts into actionable investment strategy and portfolio decisions. She identifies macro themes, policy choices, economic factors that affect global asset classes, and is the go-to person for client-facing economic analysis and market strategy. Alicia is a regular on The Record Source, live broadcast commentator, and breaking news analyst for a variety of media outlets, including Associated Press, Barron's, Bloomberg, CNBC, where I've seen her on there, CNN, Financial Times, Fox Business News, New York Times, Reuters, Wall Street Journal, Washington Post, Yahoo Finance, and so on and so forth. She's been on the cover of Feature Magazine, Kiplinger Annual Where to Invest issue. Alicia received a BA from Brown University, earned an MA and PhD from University of Chicago. In addition, she was awarded a predoctoral fellowship from Stanford University, a postdoctoral fellowship from Harvard, and a research fellowship from Hoover Institution. What happened? No Princeton? What's going on? All right. So, Alicia, let's look backwards before we look forwards. 2020 was a unique and volatile year. What do you think were some of the best lessons that we learned from last year?
So thanks, Mark. And I'm embarrassed you read that, but thank you. So there are two really big lessons from last year as it pertains to markets, right? So there are two big lessons. And the first lesson is that in 2020, policy was more important than fundamentals. That was it. The Fed stepped in, the US government stepped in with fiscal support, and within days, markets stabilized, and therefore we turned the market starting on March 23rd, despite the fact that the worst of the pandemic was in front of us. So policy was more important than fundamentals, something to keep in mind as we slosh along with all this liquidity into 2021, okay? And the second big lesson, and really this was a lesson for me too, because I will tell you, I was not one of those people saying to buy stocks on March 22nd, okay? I had lived through the dot-com boom. I had lived through the global financial crisis of 2008 and 2009. And I thought the worst was ahead of us for asset prices. And the lesson that I learned personally and investors did along the way is that markets are forward-looking mechanisms. We all know this, but in the moment that we're spiraling down, it's very hard to remember that because it's emotional. So markets are forward-looking discounting mechanisms of 6 to 12 months, and you forget that at your peril, really, when you manage assets. So two big lessons: policy over fundamentals and the forward-looking discounting market. Those are the two huge lessons, huge.
So the fact that we had a GDP print that was the worst since the Great Depression didn't really matter. It was more of how the policy, how they reacted to that, the amount of money that they put into the system.
Right. And in the end, the market was saying, well, what is it going to be 6 months from now? Is it going to be better or worse? Kind of as simple as that. And the answer was better.
Okay. Well, some of the biggest winners, talking about last year, some of the biggest winners were tech-oriented, stay-at-home type companies. Do you think these companies have legs and can they go much higher?
So look, that's really a great question because investors were really forced to be overweight a lot of these growth names and large cap tech, because if you weren't, you woefully underperformed the market. You know, we had a daily exercise where we ran the top 5 large cap tech stocks against the 495 other S&P constituents. In August, the outperformance was 65% year to date. So people got thrown into that trade if they wanted to keep up with the overall market. And then, of course, we know the rotation started happening in the fourth quarter. I think that rising yields are going to pressure price earnings ratios in the growth sector because those are long duration assets. So while clearly we've gone towards a more digital world and that trend will continue, I think for many companies, the bolus of growth has already happened. And again, project forward 6 to 12 months. Where is that growth rate? Is it the same as 2020 or is it slower? So I think for some of the companies, you're going to just see coming in a consolidation of price action based on lower PEs, and also growth simply is not going to be as spectacular as it was during lockdown.
So, Alicia, I want to take a look because I know you do a lot of macro work. So I want to look at kind of the macro view, go micro in the U.S., and then also, being that this is Exit Planning Institute, we also want to take a look at M&A and that activity. So, first, global. What's your thoughts on this year, the world outside of the United States, from a business standpoint and a stock market standpoint?
So again, I will use my markets look forward 6 to 12 months. That is the framework how we need to think about it. I think that we are projecting global growth actually fairly strong in the second half of the year. And some of the countries that were most hit will grow the fastest as a result. So we like emerging market Asia. We like Europe. We especially like the UK. We have to go through the air pocket. I'm calling this the air pocket, which is like the end of the fourth quarter, first quarter slowdown due to the lockdowns. But countries will come out of it. There's so much stimulus from central banks and fiscal support. We think that actually overseas investment, as long as the dollar stays weaker, looks like an interesting opportunity this year. We think that's very supported. We also like small caps here in the US as well for similar reasons. The cyclical recovery is ahead of us and you want to get in front of it.
Excellent. So in talking about international markets, you mentioned what specific international markets and what specific emerging markets do you like?
So I like emerging market Asia. I
Asia.
think in many ways Asia, in part it's reflective of managing pandemics better than the developed West does. Asian economies just have more experience with SARS, and they've developed policies that the population goes along with, and so therefore the dent in economic activity was just not as bad as it was in the West, the US or Europe or the UK. So we like emerging market Asia. I think UK is really interesting coming out of Brexit, and I think they've had a terrible, terrible year. And I think going forward, the data actually aren't so bad in the UK. So we think UK markets look really interesting, and I think Europe's worth a bite also. Since it's interesting, for the last 4 years, the US has outperformed Europe by close to 75%. And I think that markets don't stay that extended for long, and so it's hard to time markets, but this seems like a good time to take a bite out of other markets, including Europe and the UK.
Okay. Great, thank you. And coming back to the United States, the government has and it is continuing to supply fiscal stimulus into the economy in response to COVID. What are the implications of all this money that has been pumped into the system now, and what's the longer term implications?
So there's short term and there's long term. I think that we can't really overestimate the magnitude of the fiscal. I'm not even going to call it stimulus. I'm going to call it support, because that's really what it is. It's direct support to households in order to get them through deep unemployment that can last for months, maybe nine months or to a year. So if you think about it, in late March, early April, there was close to a 10% of US GDP passed.
Right.
In December, there was 900 billion passed, but some of that was from the previous stimulus, so about 450. So that was about 2.5% of US GDP. From that stimulus bill in March, already, first 12 days of the year, 2021, 130 billion has been disbursed from the US Treasury to qualifying households. And of those people who receive those checks, credit card spending is up 20% in the first week of the year. Okay. GDP estimates are actually now being moved upwards for the first quarter, even though the fundamentals kind of still look a little iffy on consumer confidence and the labor market, simply because the stimulus and the support is actually really working. So the people who are earning less than $50,000 a year are spending the stimulus checks. People who earn more than that are banking it. So before the new stimulus checks came in, we had $1.4 trillion in extra savings in the aggregate in U.S. households. We think that gets spent by the second half of the year as we vaccinate the population and there's pent up demand. If we add more on top of that, right, more. So Biden announced his $1.9 trillion rescue bill, including $1,400 checks to the same individuals and households, then the savings and spending is going to be quite remarkable. And we think GDP estimates have to move up because of it.
So you think we can get a 5 or 6% print on GDP?
I think the second quarter is a 10 to 12, probably easy, because don't forget that was the terrible quarter. We're lapping it. I think the second half of the year somewhere can be between 6 to 9% growth.
Wow.
But it really depends on whether this vaccine rollout is successful. And it appears there are logistical challenges. The market has priced in a 6-month return to normalcy. If we don't have visibility on that by April, May, June, then I think asset prices could be at risk there.
With all the printing of the money, are you worried about inflation? And if so, what do we do about it?
Yeah, so we see a higher risk of inflation. There will definitely be higher inflation in 2021 simply because it's arithmetic, right? It's base effects. You lap March, you lap April, you lap the months when there was zero economic activity. So of course inflation will look hotter and higher on a year-over-year basis. But the question is, what happens long term, 12 to 18 months? And the Fed is really focused on the long term. The Fed has told us that they're going to do nothing as inflation prints come in hotter for the first part of 2021. I think there'll be higher than expected demand because of all the fiscal support and the elevated savings rate. And on top of that, we have bottlenecks in the supply chain and shipping costs. It's really amazing. Shipping costs from Asia year over year are up almost 100%.
Wow.
And that's about supply chain. That's about supply chains, and that's about bottlenecks in the supply chain. And so the Fed will tend to overlook supply inflation, PPI and that, because they'll see it as perhaps temporary. I think the inflation coming from the demand side will be, if it lasts more than 18, 24 months, that will be something the Fed will react to. So in the short term, yes, we'll have it, but it won't matter because the Fed will sit on rates.
Okay. For everybody, I'm going to continue to ask questions, but I encourage you to hit the chat box and put some questions out there. I want to make this collaborative. So let's get micro for a second. A lot of people on the Zoom help business owners with their exit. M&A is very important to them. Where do you see the M&A market this year?
Wow, we have the perfect storm for M&A. It may be difficult on the regulatory front for larger firms, but just what's out there when you think about what happened in the bond market this year. So we had records amounts of cash raised because of the Fed supporting credit. And that's how the Fed supports the real economy. It supports credit. And so it supports businesses that can't reopen and just needed cash to pay their debts. So we have a really interesting situation where we have cheap cash on balance sheets, cheap credit on balance sheets, and expensive equity. And that is really a ripe situation for more M&A. Corporates raised $435 billion last year in cash. That's almost, I don't have to tell you, it's $500 billion. We think a lot of that will be used towards M&A. It's really a ripe environment. I'd say the one thing I'd be a little cautious of is the incoming administration's regulatory stance. That is a wild card. But in terms of, is there enough out there to do it? Yes. And so I would expect it.
I'm going to ask another question, and we have a question from the group. Are there any particular industries that might get more M&A activity that we should all be looking at or concentrating on?
Yeah, so I think healthcare is really the main one that comes to my mind. I think there's no, if you just look at the stimulus bill, there will be so much public and private capital coming at biotech and pharma and tools, biotech tools and all those kinds of companies that you need for drug development and for dissemination of drugs and everything from med tech and that kind of thing. So I think that sector is really ripe for some sort of consolidation because the capital coming at this is not going to stop with the pandemic. It's really a sea change, I think, in what government's role is in developing a public health sector in this country, which in some ways is underdeveloped compared to other countries. So I think that's an enormous area. I also think that your small cap industrials, I think, are really interesting here. The industrial sector, the manufacturing sector, has been on a tear. Okay, and it's been on a tear since the spring because services got decimated because we can't gather. We can't gather in the New York hotel and have a wonderful dinner or cocktails the night before or that night to discuss. We're sitting here. So the services got decimated, but manufacturing went back to work and individuals bought things. They bought things, they bought homes, they bought cars. And that means that entire supply chain really was strengthened. So I think you'll see winners and losers. I think you'll see winners buying their competitors in the small cap industrial space. These companies actually did okay. It's the service companies that really were decimated.
That makes sense. Well, we have a question. Jeff Stern. Jeff, thanks for the question. He was asking, at what point does the government need to focus on reducing debt versus stimulus and infrastructure?
Look, this is really the big question, and I think it's not going to be yet. I think that the thought that a blue wave would produce $4 trillion in spending bills this year, I think we're going to see that. We've already seen close to two. I don't think it'll pass as is, but certainly the wish list is there. And the Fed, by sitting on rates, is ensuring that the U.S. can service its debt. Now, it depends whether we have a capitalist economy in the end, and whether when financial repression ends, because we're in this really strange situation where growth looks so strong going forward, and yet yields are so low, and it's this weird pocket. We're in a regime change at the Fed. I don't think the U.S. focuses on this until the labor market is back to 4% unemployment, until we have a sustainable growth rate between 2 and 3% in the real economy. And I think that's about 18 months.
Okay. And another question from Larry Bogar. Do we expect to see manufacturing growing in the United States?
I think what you're seeing globally is a desire to renationalize some supply chains, and that tends to be manufacturing. I think that countries, for the most part, felt exposed by the inability to manufacture what their countries needed to get through the pandemic. There will be some pressure, even though there's no Trump, to bring some supply chains home. Because when you have a contract for something and you can't get it because it's sitting overseas, I think that was a rude lesson to learn. And so I think that there will be some growth in manufacturing here. I think the housing market will be one of the main drivers of that, simply because the country is underhoused. This is a generational issue, and we see a stronger housing market moving forward not simply as a reaction to COVID, but because there's a generation of potential homeowners who do not own homes and will eventually.
Is that just in and of itself inflationary if you're bringing manufacturing here and that's going to be higher costs? And
It
if real estate goes up, is that inflationary?
Here's what's inflationary: wages. So wages will be inflationary. I think the S on ESG and the focus on the well-being of the labor force and what's a livable wage, that is not going to be positive for corporate bottom lines. It just isn't. Will lead to some sort of wage inflation overall. Many states have already moved to higher minimum wage. I don't think that um, what's in the proposal to $15 an hour is necessarily a shocker, because many places, high density areas are already there at $15 an hour. But all of it's inflationary. So higher wages here in the US, not being able to use cheap labor or cheap manufacturing overseas. I don't think that the housing market is necessarily inflationary unless there continues to be diminished supply. And that really needs to change so the entry homeowner can afford it.
Right. Okay, that makes sense. Where do you see, just switching things a little bit, where do you see gold and its use in portfolio construction?
So I like gold. I like hard assets here. And I like hard assets because we're still at negative real yields. And that means on an inflation adjusted basis, you are getting a negative return on your standard fixed income treasury. And so when you have negative real yields, even now, even with yields moving upward, it's because inflation expectations moved upwards more. So you still have negative real yields of 1%. When you have that kind of complex, it really defines the entire market because it puts people into commodities. So hard assets, gold is one of them. It's also putting people into Bitcoin. But that's really like the overarching, like, why is this all happening? Why is there TINA? Why is there no alternative to equities and, hard assets? And it's because your negative real yields are at 1%. So that's how you want it. So I do like gold. It held support. It's moving here, and I think it works as a risk offset to some of the liquidity issues that we all find ourselves trapped in.
Follow-up question on from Larry was when you talk about inflation, are we talking about 3%, 5%, 7%? What range are we talking about?
Okay, so I think we're going to see prints easily of over 3% in the spring. But again, that's because of the base effect, meaning you lap the calendar year. When you do year over year, we were in the middle of a global shutdown. I sent a chart out one week. 55% of the globe was under lockdown, like the first week in April. So when you have a situation like that, you're going to get very scary looking inflation prints in the spring. So do not be afraid. Do not be afraid. This is an artifact of the calendar changing. I think the Fed gets interested at 2.7 to 3%. And I think there's a good chance we see it, and it will only matter 18 months from now, not now, because the Fed has told us they're in a new regime and that they're willing to let inflation run hotter than 2% to get to their average of 2%.
Okay. Just going back to the housing market just for a second, I've read that due to the lack of building, that one expert said that we're in the fourth inning. What's your thoughts? Is that what you think?
Yeah, I mean, previously I worked at Angelo Gordon, and we had a mortgage-backed security business. So I used to look at housing data all the time. At some point in 2000, I want to say 13 or 14, the level of home ownership in America was equivalent to what it had been 45 years earlier. In
Wow.
the early 70s, we essentially erased two generations of home ownership with the global financial crisis, and households delevering their balance sheets, trying to get back to healthy, and simply not wanting to own the asset, even with rates and yields and mortgage rates so low. We've now gone through an underhoused market for a long time. It's the millennials are classically underhoused. in part because they've got student debt. And I think you're going to see, I agree. I think we are in the fourth inning. We may have pulled some home ownership forward in 2020, but not entirely. Um, we are nowhere near what the average home ownership rate is in the US. And as yields stay low, what's really interesting is even as yields have moved upward, the 30-year is still under 3% because the spread, well, banks have to make a living somehow. So even when yields were 56 basis points, you know, your 30-year mortgage wasn't 2%, it was 2.7, 2.8. Well, guess what? It's still 2.9, even with yields at, 112 basis points. So the, mortgage rates are still remarkably low despite the 10-year moving upward.
Once again, anybody that wants to ask any questions, just go to the chat box and send those questions there. So you mentioned the elevated savings in this country. There's a tremendous amount of pent up demand. I talk to people all around the country. They can't wait to get out, go to dinner, go on vacation, spend. Is this going to be the roaring 20s?
So look, if it goes well, meaning really the only thing that matters is can you get the vaccine into people's arms, right? That's it. That's how you get the roaring 20s. We're set up for it. We have enormous household savings. We have more coming from the new Biden rescue plan, even if it gets cut down to $1 trillion. That will still be an enormous amount of support for the economy. Nobody can take being inside anymore. And, in the aggregate, there are much more savings for the US consumers. And look, US GDP is 70% consumption. So we are set up for the roaring 20s. But look, my biggest risk is the vaccine rollout. And I'll just say Israel has vaccinated 30% of its population. The US is somewhere between 4 and 5%. The UK is at 5%. UAE is about 15%. So, you know, we have supply. It's not getting into people's arms. I don't know why. I don't know why.
Yeah. Let me see. I think we might have some more questions here. Okay, so we keep hearing about the burden of student debt. If these kids can't handle $100,000 of student debt, why do we expect them to go into a $500,000 mortgage?
Because the low rates help everything, both on the student debt side and on the housing side. And I think there's going to be some forgiveness of student debt from the new administration. I
Mm.
think the nationalizing of the student debt has been in the cards for about a decade because it's just, I think it's, what is it, 1.8 trillion now? It's going to be nationalized in some way.
So what
It's going
kind
to
of
be for,
forgiveness? Give some examples. Is it going to be higher, very high education, like MBAs, or?
I think it'll be incomes of 125,000 or lower will get some part of their student debt forgiven. It'll be income based. Everything is going to be income based, right? So when you want to think about policy going forward, it's about equalizing, and it's about equalizing the burden that the lower quintiles have had to bear through the pandemic, just supporting themselves and rent and everything else. And so it's going to be income based. So it doesn't mean that, if you're earning $90,000 a year and you have $100,000 in loans, I don't think that all gets forgiven, but a piece of it will, and that will open up investment in other things.
So does that mean that tax rates are going to be going up?
Tax rates are definitely going up, my friends, and we're in a new tax regime, 90% likelihood right now. So we had a close to $2 trillion rescue plan from the incoming Biden administration. That does not involve new taxes. What will involve new taxes is the infrastructure plan, Build Back Better, where there will be investments in the economy and infrastructure and green energy and things that the government investment can help along, including clean water and clean air. I think the Biden administration is really committed to a whole of government approach. I think Joe Biden's actually the most green president probably we've had. It's not saying much, but I think that is the case. And with that, I expect over a $2 trillion, it's going to be called infrastructure, or it's going to be called Build Back Better. And with that will come tax increases. So
In what
income for,
format? In what
so
format?
100% it's going on the corporate tax rate. I think the minimum rise is from 21%, which is what it's today, to 25%. Even Joe Manchin supports, he's of course the conservative Democrat from West Virginia, even he supports higher corporate tax rates of at least 25%. I don't think it goes back, I don't think it goes to 28%, which is what Biden's original proposal was. I think, he's going to need a couple of Republicans in there, and he's going to need Joe Manchin bare minimum. So I think corporate goes to 25%. By the way, that cuts your S&P earnings by about 5%, everything else being equal, if you hold everything else constant. Personal rates are going up on the high end from 37 to 39.6%. That's going up. There'll be an attempt to reinstate the SALT deduction. I don't know if they'll be able to get it, but there will be an attempt to offset that. The problem with that, it looks like a giveaway to the wealthy, and it may not pass the progressives in the Senate, but clearly the New York delegation and the California delegation, where the marginal state and local tax is almost 14%, is very interested in reinstating this. But again, it does look like a giveaway to people who earn a high income and have high uh, taxes on their real estate. So that's going up. I think there'll be higher taxes on capital gains. I don't think it'll be necessarily equivalent to the highest income rate of 39%, but it's going up maybe to 30%. By the time you add state and local on it, you're not much different than short-term capital gains. You're maybe 8 or 9% lower in those high tax states of Illinois, California, and good old New York City, which I call my home. So not really looking forward to that. And those individual tax rates are likely to be retroactive to January 1st. Now, what could happen? What could happen is that the tax package starts in 2022. So you kind of get the gravy first. You get all the spend, you get this bolus of money, you get all this money supporting households and infrastructure and green energy and minimum wage to really get the economy moving quickly, because the longer we wait, the worse the recovery will be, right? You get that in 2021, then maybe you get the taxes in 2022. That's possible also, but you're getting higher taxes.
Okay. And you're not sure this year or next year. We will see.
It depends whether they have to use reconciliation or not. Reconciliation requires dollar for dollar an offset. You spend $10, you have to bring in $10. If they use reconciliation, it'll be this year.
Okay. Any other questions from anybody? Question. What about estate credit? Thank you, Stephen.
So I think that the exemption is going to be lower. And I don't know what that is yet. We have a lot of feelers out to people, but it's going lower. It's now, I think, 11.2 per person. So something like 22 and a half per couple. I think you have to expect that goes lower. I also don't know whether they're doing a step up basis or not. And there's some talk of taxing capital wealth, which, as we know, France tried to do, and it was a dismal failure. Some Western European countries have tried for a year or two. What they got was capital flight. But there will be some talk about taxing wealth. I think you need to think about this tax regime is really about bringing equality, and all that means. So keep that in mind. But there's no question that the exemption per person is going lower.
And any quick thoughts on Bitcoin was another question.
Yeah. So
thank you, Gina.
Yeah. So look, Bitcoin is an expression of the discomfort of the liquidity trap that central banks have set and the printing of money. And as a very dear friend of mine said this morning, I'm just not going to get in the way of central banks printing money. You can't short the market, and you can't short any of these things because they're all an expression of the printing of money. Bitcoin is part of that. I'll say this. In addition to the the action of central banks creating an investment opportunity. It's simply easier to buy, right? 80-year-olds are buying Bitcoin right now. There are ETFs. It's easy to do on Robinhood. 16-year-olds are doing it. I can tell you from experience. So, yes, everybody's got a Robinhood account, and so that's what they're buying now. Can it double or triple from here? Of course it can. Can it fall 70%? Of course it can. It is finding its price. And I think that the capitalization is low compared to the opportunity, but it's moved in a parabola. So you have to be careful. But it's here to, I believe it's here to stay.
Uh,
And central banks did it. Central banks did it.
Muriel Chang asks, do you think that they'll incorporate a VAT tax like they do in Europe?
I don't think so. I think that's off the table. I think we're going to bring back some of the favorites, like this, the state and local, to cover some of that. I don't think we'll have a VAT tax. I think that the wealth tax will be discussed and then not enacted on, because it's very hard. And taxes on unrealized capital gains, if you may remember, Elizabeth Warren in her policy platform wanted to tax unrealized capital gains. Those of you who invest for a living can imagine what that'll be like. Don't be scared of that, because I don't think it's going to happen, but it won't be a pleasant conversation who people work in investing assets. It won't.
All right, Michael Givner says, as the inevitable increase in taxes for everyone is in the medium term, the states that are already in dire financial states, New York, New Jersey precisely, will this only further fuel the mass exodus out of the region of both corporations and successful individuals? Question. Not only will these states have a larger hole to dig out of, they'll be losing precious taxable dollars at the same time. Thoughts on that? And forgive the typos. No problem on the typos.
No
I got
problem on the typos. The problem is the capital flight. Look, I think the short answer is the flight has already started to happen. If you think of the leaders of large cap tech, who tend to be libertarians, right? They're libertarians, government off my back and let me grow my business. They're moving to Austin, Texas, right? For a reason. The marginal local tax rate in California is 14% between state and local. 14%. It's the same in New York City. People are moving to the extent that we're no longer tethered to our places of employment because of opportunities like this. I think you will see capital flight. Just a personal statement, it's anecdotal, but sometimes the anecdote is the story. People around my generation raised kids in New York. I'm born in Brooklyn, raised in Queens. I never thought I'd live anywhere else,
Brooklyn.
and I'm looking for my house in Boca. And that's it, because all of a sudden the costs for all of us outweigh the benefits, and it's overnight. So if we never have to go back to the office, yes, you will see, and you already see part of Wall Street moving to Florida. There's a reason.
All right, so Alicia, I'm going to end with a lightning round. Okay, you ready for a lightning round?
Yes, I'll be my best Jim Cramer. Yes.
I'm going to ask one thing or the other, and you'll tell me how you feel. You ready?
Yes.
All right, here we go. U.S. market or international markets this year?
This year, international now, U.S. later.
Okay. Emerging markets or international markets, not emerging?
Still international developed, because only emerging Asia. Only emerging Asia.
Okay.
Okay.
Moderna or Pfizer vaccination?
Bad news out of Pfizer this weekend. Both spike protein, I would say probably Moderna. Pfizer gets you back to normal quicker, but Moderna.
What was the bad news? What's the bad news on Pfizer?
So they had some frail elderly in Norway dying after getting the Pfizer vaccine.
Oh.
Ew.
Okay.
But it's all frail elderly, like the side effects were too much. But
all right.
Yeah. Okay.
Back to the allergic reaction, Larry said. Okay, so back to the lightning round. Over or under for the full year, 2.5% inflation this year?
Over.
Over. Okay.
Over.
All right. Relax.
Okay, sorry. No, I get excited about these things.
Okay. Got me scared here. All right. Gold or Bitcoin?
Gold.
Quick. Gold.
Gold.
Okay. All right.
Gold.
US dollar 2021 goes up or down?
Down.
Down. Okay. Small cap or large cap?
Small.
Small. Okay.
You buy small coming out of your recession, always. It always beats large cap, always. 18 months.
Okay. Go small. Value or growth?
Value.
Okay. $2 trillion or more of federal help this year, yes or no?
More. Yes. More.
Okay. Will the New York Knicks win a championship before 2030? Yes or no?
No.
That's it. You're out. You were from Brooklyn. Come on.
I'm
You're a New
moving to
Yorker.
Florida. I'm moving to Florida.
All right. Well, Miami Heat, I guess. And last, who will win the Super Bowl?
Yoda? I don't know.
Yeah.
I don't know. I
Okay.
have to ask my son.
All right. On that note, yeah, we have a new football team. It's called Yoda. It's called Star Wars Yoda. Alicia, you said it all. Thank you so much for everything.